All right, welcome back, everyone. We're going to be talking AMD. We're going to look at the company, the financials. We're going to run a DCF model and see what this thing is worth. But first of all, if you've been enjoying the kind of content I'm putting out, go ahead and sub to the channel and give this video a thumbs up. I'd really appreciate it. This does let me know I'm doing a good job, and hopefully I'm adding value to your day with content like this. Okay, so let's continue on. The first thing we want to do is look at AMD's growth. That would include looking at their revenue growth, their free cash flow growth, and their net income growth. So we go to just that, and we can see their revenue has grown from $5.2 billion in 2017 to $16.4 billion in 2021. So that's fairly substantial growth. But what has also seen some pretty incredible growth is their net income and free cash flow. Back in the year 2017, they were both in the negative. Respectively, net income was negative $33 million, and free cash flow was negative $101 million. They've both grown to over $3 billion now. Now that's some impressive growth on AMD's end, so let's go ahead and move on to looking at their debt. Now the first thing I like to look at is the average of their last 5 years of free cash flow, which was about $108 million. Then multiply that figure by 3, and we get about $2.4 billion. Now we want that number to be bigger than their long-term liabilities. In this case, it's not. Their long-term debt is about $5.5 billion. Now, quick note here, in AMD's defense, this isn't really entirely accurate or fair. I'm just running the normal steps that I would. But remember, the free cash flow back in 2017 and 18 was negative. So that did not help their average at all. If we were to instead take the last year of their free cash flow from 2021 and multiply that figure instead by 3, it'd be over $9 billion. And now that is suddenly a lot bigger than the long-term liabilities that were $5.5 billion. Now, the other thing I like to look at when it comes to debt is the current ratio. Current ratio is basically just saying, can the current assets of the company cover the current liabilities? Current assets are about $8.5 billion, and current liabilities are about $4.2 billion. Any number over 1 means they can cover it, and I like to see it typically closer to 2. In AMD's case, it's pretty much right at 2, so that's perfect. Okay, everyone, now we've come to the part of the video where we need to look at the DCF model to come to a fair value for the company. But first off, we need to come up with a revenue growth rate. This took a little bit of thinking because a lot of people will have different opinions about what their growth rate should be, considering how well they've been doing as of late. However, as usual, a really good place to start is to look at the last 5 years of growth on average. We can do this by getting the compound annual growth rate, and it came out to about 25%. I also did want to take into consideration that analysts for the next 2 years seem to think that AMD will be close to 30% in growth. Now that's just the next couple years. Remember, we do need to look 5 years out. This was a tough decision, but these models do need to be kept conservative, and I really honestly couldn't justify something like 25%, considering that's what the last 5 years was. So I went with 20%. I do think that's a fair growth number to stay conservative. So we grow their revenue out 20% over the next 5 years, projected to year 2026. And that comes up to about $40.8 billion. We then applied a free cash flow margin. And real quick, this was actually kind of difficult to come up with too. Remember that free cash flow margin is just free cash flow divided by revenue. So you can do that for the last 5 years of the company and come up with a percentage, and then you can apply that to your projected revenue. But we ran into a little bit of a problem when it comes to AMD. 2 of the years were negative free cash flow, so I can't use that. And if we look at the numbers, you really want to see consistency. But because AMD has been changing so much, there really wasn't that much consistency. 2019 was a measly 4.1%, 2020 was 7.9%, and then 2021 jumped all the way up to 19.6%. So like I said, completely inconsistent. Again, this made coming up with a margin really difficult. But I did have to keep some things in mind. Remember, it's the business is getting better, and they even said their margins have been getting better overall. You'd expect to start seeing more consistency. So I'd have to imagine, just my guess, that we're gonna start seeing free cash flow margins closer to the 20% range. Maybe a little under, but usually probably about pretty close to 20%. As we said before, 2021 was 19.6%, but it still weighed on my mind that just 1 year before it was 7.9%. At the end of the day, I went ahead and chose 15% as the margin that we will apply to all of these projected revenues. So back to the model, we apply 15% margin to all of those projected revenues. We have to get a terminal value for projected free cash flows. We got that based off the last year of the projected free cash flow here in year 2026. We also had to apply a weighted average cost of capital. I use 7.2%. I like getting my figures for weighted average cost of capital from finbox.com, and we applied a 2.5% perpetual growth rate. I discounted all these numbers back at my rate of return of 12%. Then we added all the values up, divided by the shares outstanding, and it came to an intrinsic value of 56.02, or we'll call it about a fair value of $56. Now, some people may be outraged by this number. I was actually a little surprised to see it was this low. You may not agree with the metrics that I put into this model, so obviously, according to the model, this is definitely not a buy. Now, I'm certainly not going to debate with anyone who's going to say, oh, well, this is, ridiculous, and I'm hype AMD. And I must say, even if I was way more aggressive with the metrics I used, like a free cash flow margin of 20% and a revenue growth rate of instead like 30%, which meets close to where the analysts were projecting and basically not being conservative at all. But I mean, dang, I think even if you had this at like 35% revenue growth, it still would be overvalued. Great company. I personally am not buying the stock, especially after running this model and realizing just how badly overvalued it is. Some may disagree. I'm not trying to debate if AMD is a good stock to hold or not. I'm just letting the numbers do the talking, and they did the talking. But alrighty, everyone, that's gonna wrap this video up. I really hope you enjoyed the video, and everyone, you have a great day.